Hi there, I'm Pamela Ambler. Welcome to I See Your Trade, the show that looks ahead with fresh insights and data-driven deep dives. In this episode, the rise of retail investors. They now account for anywhere between 20 to 25% on most stock exchanges. That means 1 in 4 investors in the market is an individual likely trading with their own money. So how does this retail army change the game for investors? I'll be joined by our guest, Nicole Elliot, technical analyst and private investor, who's joining me from London. I See Your Trade is brought to you by IC Markets, a leading high-performance trading provider. Trade up to IC Markets. Now let's start by looking at the rise of retail investors. On the topic of retail investors, one company springs to mind: GameStop. Back in 2021, GameStop shares surged from $4 to $483 a share in a social media frenzy whipped up by retail investors on Reddit. It was one of the first times an entire army of retail investors using mobile brokerage apps were able to essentially upvote a stock en masse. Before GameStop, most retail investors had participated in the stock market via an intermediary like a mutual fund, a retirement fund, or through a professional advisor. Not anymore. Armed with their mobile phones, the retail army were able to add billions of dollars to the market cap of a video game company. That before its meteoric rise had been tracking lower for the better part of 5 years. There was even a little-known Australian mining company that surged in a case of mistaken identity. The GameStop saga gave rise to the term meme stocks, which are stocks that are promoted and shared to retail investors using social media channels. Retail investors established their presence, and they didn't leave. A study of the GameStop fiasco by Harvard University suggests retail investing can enhance the voice of regular people, and that so-called inclusive capitalism can increase corporate accountability. So more retail investment is good, right? Maybe. Does more need to be done to protect retail investors from themselves and protect the capital markets from the impact of their unpredictable behavior? What is clear is that GameStop wasn't an isolated event. Since then, retail traders who lurk in forums like Reddit's Wall Street Bets are back to betting against Wall Street pros and the Federal Reserve. We're now in an era of social trading. This means that markets are susceptible to people power and can change quickly when investors make bets in a chorus of coordinated activity. Where to from here? And can sophisticated investors and retail traders coexist? If you're listening via audio only, now's a good time to tune in on the screen to reference some charts. But for our listeners, we will also talk you through the data. My guest today is one of the world's leading commentators on retail investing. Apart from being a former technical analyst for Credit Suisse and Mizuho Bank, she's Nicole Elliot, technical analyst and private investor, dialing in from London. Thanks for joining me, Nicole.
Lovely to be here, Pamela.
Well, let's jump right in. Looking at U.S. consumer confidence first, it took a nosedive during COVID and now taking a double dip. What's the big takeaway here?
Confidence in all things in life is so very important, Pamela. That's why I've started off with this chart. And as you rightly point out, in the last 2.5 years, U.S. consumers have really not just taken a beating, but it's been over a long period of time, much longer than we'd expect. And that's what I wanted to show in this chart. It's not the end of the world at all. It's not. But we should take this into account when deciding how much and where to invest. That's the point of this chart. And by the way, I'm delighted that you've decided to use charts in this show, Pamela. It's the bedrock of my investment decisions.
And now turning to precious metals, Nicole, trading volume in gold is nearly always higher in bull markets. Is that what we're seeing here with the yellow metal? Is it being treated as a risk asset or safe haven?
Well, I don't think it's risk on or risk off. The point is, because retail investors tend to only buy things, i.e. go long, as they call it in the jargon, there's more interest and more volume when the market is trending higher. And with gold, it hasn't been trending too much. And if anything, it's actually declined in value in 2022 so far. And therefore, the volume is far lighter than it has been. And this is just something to remind you that there is this huge bias by retail towards bull markets.
And inflation, it's stinging almost everyone, everywhere in the world. And a key contributor is the oil and gas supply crunch. What is this next chart telling us?
Well, what's interesting is that here in Europe, there's been such a hullabaloo about Nord Stream and gas from Russia. I mean, our newspapers, our televisions, our radios are just absolutely covered in this stuff all day long. And if you look at the NYMEX crude oil, the New York Harbor one, you can see that actually we've peaked already quite some time ago. That's a very long-term chart I've given you there. At its center, the blue line is a mean regression, and I've drawn one standard deviation around the mean, on the upside and on the downside. And as you can see, we've already pulled down to the upper standard deviation level. In other words, we are not at extreme levels. It is expensive, yes, but it's come off. You can also see this mercifully in US gasoline prices at the pump, both wholesale and retail. They've really come well off the highs earlier this year, which is a blessed relief. I mean, today China has said that they expect their oil consumption to drop by approximately 20%. So I think the pressure on crude oil, gas, coal, gasoline around the world, except in Europe, is about to pull back, and it should be great news for the consumer.
Yeah, and it is precisely this pricing on oil pullback that is seeing CPI tick down just a slightly lower from the previous month. Now, this next chart is the UK 2-year gilt. What signal is this chart sending?
Okay, this is the yield. In other words, how much interest do you receive if you were to own 2-year British government paper? And as you can see in the triangle I drew, it has been in a tight straitjacket, yielding next to nothing for years. And that is the lowest yield on record. And then suddenly it burst higher. And this is a classical chart type pattern where if you suppress the natural movement in a particular market, as and when it moves out of its straitjacket, it absolutely explodes. And that's what we've seen in the gilt. So we've gone from next to nothing to over 3% already in the space of 6.5 months.
Exploding out of the straitjacket. I like that. Now, moving on to the power of social media. One of the key drivers behind retail investor behavior we're seeing is the power of online networks. How has social media changed the investing landscape? Social is dominated by influencers, and do you think some people are perhaps putting too much weight on their advice?
Influencers have been with us for ages and ages. I mean, Mr. Warren Buffett is, very elderly gentleman now, and he's been an influencer for generations of people. I'm really delighted to hear that Miss Kim Kardashian has also teamed up with a hedge fund to encourage perhaps a younger generation to properly invest in long-term assets. And I'm really delighted. Then you have a lot of other people who pretend that they know what they're talking about, and those are the ones to be careful of. So don't be worried about them, but just decide who to listen to. Why is this person telling me what he's or she's telling me? And does it actually have any value? So start by doing proper homework rather than just following the crowd blindly. That's the most important thing I'd say to anybody starting off.
Well, another problem with social media is that when something starts trending, it's then served up more and may give the impression that an event is more important than it actually is. Can algorithms be trusted by retail investors?
Algorithms should be treated with caution, in my opinion. Most of them, all they do is speed up a decision-making process. They don't actually create new decisions. The computer can work far faster than my brain can. So therefore, you can get more information and process it very quickly. As to whether it brings something completely new, as yet, I'm not convinced.
And in terms of the types of assets retail investors typically throw their weight behind, do you see them go with what they know?
No, I don't think they do. The trouble is, most information is on stock markets, as we've pointed out. Nearly a quarter of buyers in the stock market are retail investors. And that's because the stockbroking community has got a stranglehold on this type of investing. The reality is that the most important investment that most people make is their home. That's the number one investment, retail real estate. So that should be, I think, your first port of call. And I think everybody will agree, a roof over your head is really something very, very useful. The other port of call to consider is fixed income, bonds as they're called, particularly top quality only, not the rubbishy ones. And this is the favourite of the bankers, believe it or not. The bulk of their assets are held in actual bonds. They do not hold retail stocks. That's not their job. Before, they used to be separated out. The other thing I could urge retail investors to consider is something that has a value and a purpose. I mean, there's some delightful ones coming up now. There was always the Bordeaux wine index, where you could buy wine, perhaps drink a little bit on special occasions. The other good one is there's an index for top quality watches. So that's something else. Collectibles, as we tend to call it, is definitely one to consider. And the last one I'd suggest, and it's an old story but true, is land. And certainly agricultural land in the States and in Britain has been possibly the best investment you could have made over the last 10 or 15 years. Its implications for inheritance tax are very, very different from other assets. So to retail investors, be aware, but also what might make a proper difference to your family's lifestyle.
Absolutely. There's a lot of alternative investments available out there. Now, Warren Buffett has famously said, never invest in a business you cannot understand. You gave us a lot of examples of things that I think people do understand. Now, do you see retail investors beginning to move out of their comfort zone?
Yes, and I think we should all do so. I actually think moving out of your comfort zone is a jolly good idea. Now, I agree with Mr. Buffett. If it's something I really don't understand, and I'll be honest here, I do not understand cryptocurrencies, so I'm not investing in those. But I do understand blockchain, and I think that is very, very valuable. It's is what we call in the antiques trade, in the art and antiques trade, provenance, in that the asset has more value because you know exactly where it's come from, who owned it, how much they paid. So definitely get out of your comfort zone. If it's too good to be true, avoid, avoid, avoid.
Now, what does it take for a retail investor to graduate into more complex investing? Is this starting to happen more frequently?
Yes, I think so. And I think it's going to happen even more, Pamela. The reason I say this is that over the last 10 years or so, traditional investing vehicles like money market funds and straight savings accounts and that have yielded so little, and it's so disappointing. And now we've just had this year inflation really hitting us, so we've got double whammy. So I think this will be the spur to make people look a little bit further and beyond what they would normally feel comfortable with. Certainly in terms of stock markets, number one is, remember, if you're investing in your home market, then in theory, you do not have a foreign exchange liability. But that's not exactly true. Learn a little bit about foreign exchange because it does influence the value of shares around all over the world. And then you can compare say how your stock market has done over X, a year or 5 years or whatever, and what you might have done had you been a bit more adventurous. So keep those sort of triangulation in terms of your thinking, keep that in mind. And it's a super good exercise.
Well, homework aside, there seems to be a groupthink that underpins meme stocks. Do you think that we're going to see more retail investor-fueled bubbles? And where do you see the next retail investor bubbles forming?
Bubbles come and go, and we never know when they're going to come, and we have no even less idea when they're going to pop. So that's number one. They're very difficult to predict. It creates this sense of urgency and that you've missed the boat and that you've got to do something about it, and beat yourself up because you were silly or something like that, or boast about it because you think you're clever. That's not to say don't bother, on the contrary, but what you're looking for is really something that's strong and moving steadily. Yeah? I mean, I see these people who say, they're going to make 3x, 10x, 20x in no time at all. I think the chances of that happening are so slim, you might as well go out and buy a lottery ticket, quite frankly.
Well, now, are these amateur traders starting to flow into greater unpredictability in markets, particularly in stocks?
If I've understood you correctly, I think the retail investor has got a lot more wary this year, precisely because the stock market is down. And so I think this is a good thing. Not because they've been beaten up. I don't think they have. I think they'll come back stronger and more sensible, and hopefully, with deeper pockets as well. The point is, when you're investing, you must not give up.
And as you mentioned, it is a good thing that more people are engaging in the stock market, learning about investing and how to make a living. What has been the benefits from the rise of retail investors?
Well, the benefits obviously is to the stock exchanges themselves, because they make money on every trade. For all the people in the business, including in the futures market, the clearing houses, they too take a commission out of every single trade. For the retail investor, I think the benefit really is to get into the habit of putting money aside. I think that's really it. It's almost like the ultimate jigsaw puzzle, in that you've got all the pieces, but you don't know how they're going to fit together. Personally, I can't think of an intellectual activity that is as broad and global as financial investing.
And how can retail investors protect themselves and the money that they've generated from trading to actually build wealth over time?
Well, it's one step at a time, isn't it, Pamela? You're not going to get there in a hurry. So, be patient and don't be greedy. Do not be greedy. If you think some investment has done spectacularly well, take your money. Don't run, just cash in your chips. Say, that's good enough for me. And we'll leave a little bit for the birds. You don't have to buy the lowest price and sell the highest. Just get the bit in the middle, because that's the good bit to get hold of. The other thing is, if you're planning to pass on your wealth to the next generation, make sure either they're well advised or they know what they're doing. And if you think the portfolio you have created is too complicated for them, sell it, and then they can have cash. And I would urge people also to ingrain this in their children or their grandchildren. Ingrain the idea of putting aside a bit of money, not just for a rainy day, but to do something really great with your life that's really going to change things, maybe for not your generation, but the next one. That's the way you think. And to get there, it's not the hare, it's the tortoise.
Well, thank you, Nicole, very much for that sound investment advice. That was Nicole Elliot, technical analyst and private investor from London. With 1 in 4 traders now a retail investor, markets will never be the same. While they may not be as sophisticated as institutional capital, they are certainly changing the game for everyone. You've been listening to episode 5 of I See Your Trade. I See Your Trade is brought to you by IC Markets, a leading high-performance trading provider. Trade up to IC Market. In our next episode, we look at how to dig through the data to prepare for your next trade. Thank you for joining us today, and we look forward to seeing you next time.